This video will show you how banks make money and why insured interest accounts work. First off, you already know that banks charge account holders fees such as monthly account fees, wire fees, bounce check fees, ATM fees, and etc. But that isn't where the real money is. The big money is in what is known as deposit leverage lending. You see, banks are able to lend out 10 times the amount of money they take in on deposit from account holders. So for each $1 you deposit to, say, Bank of America, they are able to lend out $10 to others that borrow from them for autos, homes, etc. They are, of course, regulated and audited regularly by the government in order to ensure they don't go over that 10 times ratio. So not only are they lending out money that they really didn't have to begin with, but they're making interest on that money as well. This is why the banks that have the most account holders are the largest and most profitable banks. You think that they would offer free or even good interest bearing accounts due to this ability to leverage the account holders' money. But as you experience, they don't do that, as they know the general public isn't aware of this and we all need bank accounts to operate our finances from. So who are we to complain, right? Now you must think that bankers are the smartest guys in the room, right? Well, the only issue was that the only way it worked was by having a large number of depositors to your bank. And since there are already so many banks competing for account holders, it was a hard market to compete in. Well, wait till you see what some even smarter guys put together below over 100 years ago. You see, some really smart guys got together and knew that the regulation put in place by the government to allow banks to leverage depository funds in such a manner was a great deal. They had buddies that owned banks, so all they had to do is develop a virtual product that they could sell instead of selling or opening depository accounts that banks rely upon. When they sold the virtual product, they would deposit those funds to their business bank account at their buddy's bank. Since they deposit so much money with their buddy, they were able to negotiate the majority of the interest revenue obtained from the leveraged deposits, as they could choose any one of their buddy's banks, so they had the leverage. This virtual product they developed over 100 years ago was insurance. Now follow this math to blow your mind even more and understand why these guys were so much smarter than the bankers and still are making more money than banks. You see, for each dollar paid toward the virtual product of insurance, the insurance company has that dollar in their company bank account and then benefits by being able to loan out by partnering with a friendly bank 10 times that. But instead of lending that $10 to the public, the insurance company borrows $10 from the same bank and uses the insurance policy as collateral for the loan. But wait, it gets better. Then they take that $10 borrowed and deposit it back to another friendly bank and can now leverage 10 times that amount, or $100. This means for each dollar you pay for insurance, the insurance company is able to leverage not just a rate of 10 to 1, they actually are leveraging at 100 to 1 ratio. This is why you can pay pay $100 a month for 100,000 insurance policy. As due to above, the insurance company already has the money available in case you make a claim, so all looks good on the books for them. You pay $100 per month times 12 months equals $1,200 per year. They have used and are getting interest on $120,000. So this is why you are able to get a life insurance policy paying a beneficiary $100,000 upon our death. Aren't they nice protecting you? So now with knowing that, the only issue with insurance is that not too many people buy insurance. I mean, if you ask around how many people have life insurance, not many, and auto and home aren't very expensive or gain much in the form of deposits. Insurance companies realize that to increase revenue for their shareholders, they need to expand their product offerings and reinvent themselves. So since they knew that banks weren't offering any depository accounts with benefits such as asset protection, tax benefits, death benefits, or even guaranteed interest, they decided to build that product. Thus, the birth of the Insured Interest Account. Now, this type of account is unique due to the ability for the insurance company to leverage their deposits as described above, enabling them to offer all those benefits. At first, it was only provided to friends and family, the elite, and those in the know, which is still kind of true. But these accounts have also been around for 100 years now. So if you are just learning about this, don't feel bad. It isn't something taught in school or around the water cooler. So what are the nuts and bolts of this type of account, and how can you benefit from them? Well, first, all money you deposit to this type of account, say from business income, is tax-free. All the money held in these accounts is also protected against any creditors, personal or corporate lawsuits, as well as from government agencies. The accounts come with a death benefit. In case you pass away, your beneficiary will be paid the typical life insurance premium ratio, depending on your age and health. Example above of $100 per month provides a $100K death benefit. If that isn't enough to convince you to use them, the best thing is the guaranteed interest ranging from 4% to 6%. Now hold on, it gets even better. That interest being earned on every penny you place into this type of account is compounding year after year and never goes away. The reason is, you never withdraw money from this type of account, although you have immediate access to the cash you deposit into it. How does that work? Well, remember we said that the insurance company is borrowing 100 times the amount you deposit to them. They simply don't have you withdraw money when you need it. Instead, they loan you the money, so your actual money stays in the account earning interest. Much like a mirror image of your money working day and night for you, while you use the borrowed funds for what you need it for. For instance, you make $5,000 per month income. You probably deposit that to a typical bank checking account to pay your bills and have some left over for incidentals and savings. To leverage the use of the Insured Interest Account, IIA, you would simply never hold balances in your normal bank account. You would use it as a sweep account to simply pay your bills from. All your money would first flow through the IIA, and to pay your bills you would call up to move money borrowing from the IIA going to your checking account to pay your bills. This way, the $5,000 is earning interest in the IIA, and you are using the borrowed funds to pay your bills. Now, if you do that, you will have $60,000 deposited in that IIA by the end of year one and have earned 4 to 6% interest on that money. That money is, as stated above, protected, insured with death benefits and free from taxes, as you aren't taxed on borrowed money. You can see how powerful this is for major corporations such as Pepsi, that had its most profitable year ever after deploying this strategy. No longer would they pay cash from their normal bank account. They would borrow that money from their IIA accounts instead. As a business owner, if you earn, say, $10,000 per month, you would typically deposit a portion of that money to your personal bank account as personal earned income and be taxed on it. If instead you pay the money into an IIA, you would have that write-off for your business and you would personally borrow against that IIA account tax-free, as again, they can't tax borrowed funds. Pretty sweet and smart, don't you think? Time for you to benefit from this strategy like those in the know. What are you waiting for? Get your free report and plan to leverage the power of your very own insured interest account today.